Hi, I'm Sham and I have Kishan. Welcome to Free Flow.
Yeah. Hi, Sham.
Hey, so today we are going to discuss factor rotation. At the base of it is basically, it's a very simple version of momentum. So you just invest in whatever factor worked best previously. So it might sound silly, but it has a fairly robust academic sort of proof attached to it. Um, so I think this thing was discovered by AQR, or does it predate that?
Well, I think I'm not sure about that, but I think AQR is like a pioneer in factor research or uh, it's systematic investing research. So I so I would not be surprised if they first thought and researched this. But also, it's pretty natural to think about it, right? I mean, to like apply factors based on the market. Based on the market conditions so that you can maybe apply factors in the I mean and the right factor in the right market environment. I think that's a very natural, that's like the most, that's a logical step, you know uh, or the logical way to think.
Right. So when you decompose what these factors are, right? So you have value, growth, quality, investment factors, and momentum. So um, not everything works in all environments, and there are some big stretches of time where one factor predominates. So one of the things I put on the post was how value and growth took turns in the US, right? So after 2000, for like 10 years, it was all value investing that worked. So the Russell 2000 value ETF outperformed everything else. I think it was the Russell 1000. Value ETF outperformed everything else. And after the 2008 crash, when the Fed started printing in earnest, growth started outperforming. So um, so the danger here is basically putting a label on yourself, calling yourself a value investor or a momentum investor or a growth investor, when clearly each factor can go through like 10, 12 years of underperformance. So I think for me the biggest shocker was how it was like a perfect 10 years, right? So for 10 years growth outperformed, and I mean value outperformed, and then subsequently growth took over. And most value factor investors are now just waiting for the rotation to come back to them. But what this piece of research shows is that you don't need to wait, right? You don't need to wait for the full cycle to work itself
Yes.
out. You can just look at what has outperformed recently and just invest in that factor. And that usually has worked, in the past.
Right.
Uh,
Okay.
but I think the post also points it out. The biggest problem in India is the government is the biggest broker, collector of
Yes.
brokerage in terms of STT. If you have a bunch of factors that are flip flopping, then what happens is you have like a trade to do every month,
Yes.
and the transaction cost sort of eats away whatever alpha you produce. So you're forced to kind of smooth out things. So you know so what at least what the back test shows is you have to take the average of different look back periods, to sort of even things out. And uh, and the problem with that approach is you're not reacting to recent events. So, in case of sudden shifts in the market, you will underperform and you will be slow to recover as well.
Right.
So, so this sort of tests your patience when you're going through a drawdown, and investors need to be sure of that. That it's basically we're asking them to keep faith.
and
uh, you know
and to stick with it.
yeah, and stick with it,
Yeah.
because it's proved to work. And if you look at the US experience, it works there, beautifully, because there's no STT and all that, and it's just like one ETF. So you just rotate out of one ETF and buy another one. So it works
And
beautifully.
it's more. But Sham, I have a question.
Yeah.
Markets don't. I mean, market cycles don't go month to month, right? I mean, don't shift quarter to quarter, so to say. Like you could have different market environments, and 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 you could have a big drawdown. Say I mean, you like enter when a portfolio when a market really like just for example, you enter the market momentum portfolio say in the beginning of September because the market was extremely I mean the market was in a like in you could say in the zone where the momentum uh, you know portfolio would work. But by the end of September, or at least till yesterday, the market would have reversed, right? And if you, for example, moved out of the moment portfolio yesterday, suppose yesterday was the market, I mean the month end, and you moved it out from that day, you would have to then shift out to a portfolio which is which is not momentum based. But then maybe the fall in the market is just temporary, and then by the end of next month you are already at the market might be 10% high, but you moved out of the wrong portfolio, and then you enter the momentum portfolio again. But then you might actually have a crash that happens in November. I mean, the markets don't move just because it's the month end. It doesn't mean that the market will shift based on, I mean, the factors. I mean, and over the longer period also, you might have markets moving out of different zones based on based on things that based things you cannot control, right?
Right. So, this reminds me of my high school physics class,
Yeah,
where, you're trying to harmonize with a tuning fork, right?
yeah,
So you have, say a machine that is doing like, 600 RPM or something, and you're trying to match, its vibration on your end.
right.
So this is something similar to that, because the market moves, and the market does what it does, and your strategy needs to sort of get on the same frequency as as the market. And if you're moving at a higher frequency, then what you end up doing is exactly what you described, which is whiplash. So you're moving in and out of different strategies,
Yeah,
overreacting to the market, um,
but
and
that's the thing about market timing, right?
it's slow.
So like, how would you differentiate market timing versus say factor timing?
So the factor timing is systematic, right? So you're not trying to be too smart and try to predict what which factor will outperform next. So I would, the difference between doing something systematically versus trying to time the market is just that. When you're trying to time the market, you're trying to predict what the market is going to do. So when you're being systematic, you're just saying, okay, these are rules that worked in the past, and with a fair degree of confidence, I expect it to work in the future, and this is why I'm going to do it. Um, so to your point, in terms of like there's no reason why you have to pick weekly boundary, right?
Yeah.
So you can pick a weekly boundary as well. So you can say every Friday I sample the market and I see what worked in the previous 6 months or 12 months,
Yeah.
and then do it. But then, you run the risk of overreacting to the
Yeah.
market. And this is sort of like, there's no right answer to this, because people have tried to use volatility signals to kind of either increase the frequency of rebalancing or decrease it. But the problem is, you might go through wide stretches of low wall, and then suddenly get hit with a spike in volatility. So
Right.
what happens is, when the market is volatile, you're trying to rebalance more frequently, and you get into execution issues, because it's very difficult to execute trades at the prices that the model spits out when the market is very volatile. So I remain sort of circumspect of those sort of strategies, because um, it might look great when you run the back test, but it's quite another thing to execute it
To
in
prepare an execution. Now, now, if you have to compare, bin factor rotation versus, having a diversified factor portfolio, instead of, trying to time them, you're trying to time the factors. You just say that, these factors will like average it out. Have you compared them? Like, I mean, having a multi-factor portfolio versus versus a factor rotation portfolio.
I haven't compared it, but my intuition is that you're better off betting on a single factor. I mean, that's my intuition, because number one is, if you add a lot of factors together, you end up becoming the market, right?
Yeah.
So you just end up becoming a more expensive version of the market. And the other problem is, I'm not averse to sort of using a trend filter on things,
Right.
because many times the price is telling you something, right? By ignoring price and just purely depending on factor ranking like value, growth, etc. You may be, I mean, if the signal is there staring at your face, why wouldn't you use it, right?
Right.
So some amount of trend or momentum overlay over these sort of fundamental factors makes sense to me. But that is more like factor composition. It is
Right.
not multi-factor.
Right.
Um, so yeah, I mean, I think we should test it out, and see
Yeah, we should like
what happens.
multi-factor. Yeah, like just have like 4 or 5 factors and like equally allocate funds to them, and then see what happens. Because because my guess is that I've seen some of the material online, and and it's interesting because value portfolio normally perform well, um, in the bottom, when the market at the bottom and when it's mean reverting, right? And so it's also like for me the question is, uh, factors need to be predictive to some extent to get a factor rotation right, because just looking at what happened 6 months ago is not enough, because like in the sense that even if it's by data, it needs to have the predictive insight that okay, the market's in this zone, it's most likely to perform in this way in the next 6 months. So I need to move out of um, this portfolio and then move to a to move to a portfolio which will most likely do well, which is not which goes against systematic investing, like you described it, because it's more uh,
Right. So I think it boils down to what is your time frame, because uh, going back to the example that I posted, right? So value versus growth. You
yeah,
need not get every single move right, you know because these things persisted for like 10 years, so it's enough if you get it's okay if you're wrong even for the first year of the rotation.
investing.
Yeah, so it'll eventually catch up. So it really depends on how you're trying to harmonize, and your look back period and your transaction costs should reflect your holding period. That's my rule of thumb. So if you're willing to hold something for like 20 years, you can do with a very slow moving long look back sort of systematic
Right.
strategies, because time is on your side.
Okay.
But if you're looking for something, 2, 3 years, then you need something really fast, something that is looking back,
Right.
and reacting quickly. So that's how I would pair them up. Because, nothing else kind of makes it,
Fair,
intuitive or practical sense to me.
fair
And
enough.
going back to, multi-factor, right? I've seen people sort of do a momentum and low volatility barbell as well. So they'll keep like 60% and, sort of like low wall, and 40% in momentum. So in theory at least, they're supposed to sort
Yeah.
of complement each other. um so yeah, I mean, it makes sense. We should definitely test it out.
Yeah. I think so too. I like the idea.
Yeah. So we have our next free float queued up, I guess, with that.
No, Harshad.
We'll say goodbye to our friends. Thank you for coming on Free Float, Kishan. We'll catch you guys again next week.